everybody, my name is Sam, aka Sambucha, and I'm a YouTuber who makes variety content ranging from challenge.
All right, so we're currently looking at FOMC today. So, shall we just get this underway? Okay. How's everyone doing? How's everyone doing? Are we all good? What's happening, my bro? Money Day? We're here. First stream of the week. This week's price action has been pretty poor, man. I'll be honest. It's been pretty horrendous. Let's see if we can find a setup today. We're gonna give this stream 1 hour. Okay. So, okay. So what I can see is the federal interest rate decision remained the same at 4.5%. Okay. The forecasted was also 4.5%, and the previous data was also 4.5%. So, essentially, the Fed has decided to not raise or lower the interest rate decision. Okay. To be honest, it's not the most bullish outlook for the dollar. I'll be honest. Because if you look at the data, right, I'm pretty sure we've been up 4.5% for quite some time now. Yeah, the past two previous data has been at 4.5%. So the interest rate hasn't improved at all. Because realistically, they're going to try their best to bring the interest rate down lower since we've had the whole COVID situation and the whole recession fears, right? The whole inflation issue that we've been dealing with. So it's not really the most positive outlook for the dollar, I'll be honest. Earlier on this morning, I did try to go for some longs on the Euro USD. That did not work out, unfortunately. Essentially, I'm looking at this daily picture. Right now we are pushing down lower, but there's nothing to say that we can't get a play into this down candle in the daily and push up. Like, I'm still on the side of buying EU. I'm still on the side of potentially seeing lower dollar, right? Because here's the thing: until I'm proven wrong, there's no reason to go against the daily time frame, right? What we've done with the news releases, we've just taken out that high. It'll be interesting because the interest rate decision has remained the same. We need to look at what the press conference and whether they're going to have bullish or hawkish or dovish comments. Because right now I'm looking at this price action. It's okay. It's okay. All right, who we got here in the live stream? Money Day. We got Gifts. We got Leo. Who else is in here with me?
You're thinking about going to therapy. And as a therapist myself, of course I'm going to say that's a great idea. But first, let's talk about the things they don't tell you. First of all, you're going to say, I'm fine. Like 300. Yes.
We got Jay-Z's. Money Day, my bro. I think this is your first time in the stream, no? I don't think I've ever seen your name in here. How you doing, my bro? You good? I know a lot of you guys are probably thinking, why am I looking at EU so much when my pair is gold, right? And the answer is pretty simple. Gold's at all-time highs, guys. You know, we had this move in the morning here. I was too busy looking at EU, right? That I didn't notice this buy on gold, and it's like, you know, them ones where it's like every time you step away from your main pair, you get reminded why you shouldn't be stepping away from your main pair in the first place. Oh, you're in the Discord. All right, my bro. Welcome, welcome, welcome. Guys, if you're watching the live stream so far and you're enjoying the live stream, do me a massive favor and hit that like button. Helps with the YouTube algorithms. So, okay, cool. This is what I'm seeing so far, right? So, at the moment, we do have this 15-minute candle here. Okay. We've got the 15-minute imbalance inside of here as well. And when we look at this, right? Let me get rid of some of these other areas. When we look at this, I'm anticipating to see if we can get a reaction at this low here, right? Because this was the low, right? At this point, we ran beneath this low here and this low here before we actually started pushing up to give us a new high. So ideally, this is our last down candle before we got the move to the upside. Does that make sense? Yeah. So right now, what is actually making the whole picture a little bit difficult is understanding if the daily bias, right, is going to hold weight. Right, because my other thinking is when I look out, right, and I zoom out and I look at the DXY, it's like, bro, we've been coming down a lot, right? We haven't had any forms of valid retracements or pullbacks or whatnot. You know, we're currently in a very small consolidation range, if you will, at the moment. You look at things from a monthly perspective, look at things from a weekly perspective, we haven't really done much in the past 2 weeks. Okay, so right now I'm of course bearing in mind the daily picture that this should give us a new lower low on the daily. However, I'm also paying attention to the fact that we can actually push up higher due to the fact that not only have we taken out key weekly liquidity, we've taken out monthly liquidity, and we've also hit monthly imbalance. So when you bear those things in mind, you understand like, okay, cool, we've actually done a lot, and this would make more sense for it to push up. But that's the thing about structure and market structure, right? You've got to play what you see until it's broken, in a sense that if structure is still bearish, you have to keep selling until it proves you wrong. Okay, you just have to keep selling until it proves you wrong. So for example, for EU, even though I went in for a buy earlier, right, stopped out, cool, the daily structure is still valid. You know, we may be making, at one point I thought the low of the day was here, right? So then we can start attacking these highs. Maybe the low of the day is going to be here. So look, in any case, I'm still on the side of looking at this as the daily low, right? At least on the daily time frame in terms of the swing picture. Okay. So until I'm proven wrong, I'm gonna just keep on buying. Gold's having a really nice rally right now. So right now, yeah, we just need to take our time. Just take our time. We do have a flip picture here. right? If we look at the half-hour picture, we are currently working inside this half-hour candle. The area that we're looking at on the DXY is higher though. Okay, so what do I mean by this? If the DXY, if the dollar gives us a push up from here, right? Can you see how the DXY has broken that low there? However, EU has barely even come into the area. So let's just see how it goes. So remember, like, even though EU is the mirror image of, you know, the dollar, it doesn't mean that it always follows at the exact same time 24/7. Sometimes there's going to be a little bit of discrepancy, there's going to be a slight delay, and you know, there's nothing you can really do about it. You know, I really liked my buy this morning, you know. I really did like the buy. You know, so far this week, EU has done us dirty with the sell. Right, we got a wick before we actually went to TP. Then we eventually reversed anyway, so fine. We went in for a buy. I think we went into a little bit of profit and then we just slammed down. In any case, I don't think this is a sell, to be honest with you, but here's the thing, right? If the daily picture here, which is to actually get a new higher high, I'll show you an example, yeah? If I go to gold, you're going to see the exact same picture literally formed so many times. But if I show you the exact picture that I'm looking for, is this one here. Right? So what did we do here? We had a push up, we had a pull back into the daily candle, and then we continued. So that's the exact same thing I'm looking for. We've had a push up, pull back. I want to see us continue higher. Right? So at the moment, let's see what Bloomberg is saying at the moment. Bloomberg. Bloomberg Live.
See one cut-off viewer, that's up from 4. Only 2 now see 3 or more, that's down from 5. It won't take much to move the median in the other direction. This is where I'm struggling with this decision. I feel lonely around this table. I see stagflation readjustments in the forecasts. I see a Federal Reserve that's not accompanied a downgrade to growth with an upgrade to the amount of cuts we'll get this year. In fact, quite the opposite. And they're telling you things are really uncertain right now. So it's not obvious to them how they would respond to adverse shocks in the economy. That's a change for this Federal Reserve. Typically, it goes something like this. Growth's bad, we can respond. We're not constrained because inflation's going to be lower. That's not what they're forecasting right now. Now, this can all change in the news conference. Maybe Chairman Powell could explain this in 15 minutes' time. But I just sit here and I just say, look, if I didn't see the market, I'd be sitting here thinking that was a very hawkish mix from the Federal Reserve. I know I'm very lonely. Jim disagrees, Bob disagrees, but that's what I see right now.
You're not so lonely. There is a shift in the mentality around the Fed right now, which is that disinflationary process is squarely on its trajectory downward, is no longer valid. That has been a shift, and they can no longer count on that to allow them to just unabashedly respond to downside growth shocks. And that is what you're seeing reflected in those dots. And on the margins, that's hawkish, because they're not going to necessarily come to the rescue in that way. That said, do people believe these dots, et cetera? And that's another story. So that's, I think, where maybe people are leaning some of their confidence.
Bob, is stagflation bullish risk assets?
No, it's not. It's a pernicious ingredient into risk assets. So,
what can you take away from the fact that this is a stagflationary mix to the adjustments of the forecast from the Federal Reserve, and they seem to be very uncertain about what to do with policy? Well, when was the last time they were in this position?
It's an expected stagflationary environment,
Fair point.
We're not in it now. And I think when you talk to a lot of corporate managements, you'll find that they're pretty guarded and sanguine about what they're doing. So I do worry that if what we expect to happen actually happens, then the response
Who else have we got on the live stream right now?
KPMG is going to jump in on the conversation. Bob's going to stick with us. The news conference starts in about 16 minutes time.
What are you guys looking
Fed
at?
had 14
Any
minutes to
setups
pore
at the moment?
All of this. What jumps out for you?
I actually am on your side of the equation here. I think this was much more hawkish, and the Fed not quite
Hawkish.
going to one rate cut, but the number of people who are expecting one rate or less cut this year going up, that gives you that sense of the dispersion of risk and the challenge of corralling the cats in a very uncertain environment. We've seen several Fed presidents come out and evoke the 1970s as a cautionary tale. This is a stagflationary forecast, not a horrible one, a very mild bout, but the uncertainty factor is really true. I think what you're going to see Chair Powell do is separate the balance sheet issue, because excess reserves are starting to get to that point that they really need to slow down quantitative tightening so they don't have a hiccup and some kind of seizure in the Treasury bond market. They don't want a repeat of that September 2019 event, and that's what they're hedging against. They still want to run off their mortgage portfolio. They don't want to hold mortgage bonds. Their mortgage bonds, they're going to roll off when people buy those homes, because nobody wants those right now. They're not just going to easily roll off in a very stagnant and stuck housing market. But I see this as a much more hawkish kind of tone from the Fed. Also important to note, the ingredients that go into the PCE, which the Fed has already calculated between 0.3 and 0.4%, an acceleration, not the cooler numbers we got in the CPI and the PPI. It's going to be 2.8% core PCE next Friday for the month of February. That's an uptick in inflation, both on a month-to-month basis and year-over-year basis. They know that. They've made that calculation as well.
Diane, across Wall Street, a lot of people have downgraded growth.
Just listening to what
Upgraded inflation
the analysts at Bloomberg are saying.
Policy mix in Washington,
Let's just
DC.
all listen
How does the
together.
Fed address this without getting political?
Well, that's why you're seeing so much uncertainty, and they just say, we're not going to front run any policies. This unfortunately leaves them in this data-dependent mode, and we don't know what the decision rules are on what kind of unemployment and what kind of inflation number are going to make them pull the trigger in one direction or the other, or stand hold. They'd rather stop short on rate cuts and wait for policy and to see how that plays out through the economy. That's going to be a very pregnant pause. I don't think there's any chance that they cut in May. I think that's a very low probability. We do not have a cut this year until early 2026 because of the underlying upward pressure on tariffs. Now, much we'll find out.
No
more
cuts
information
until
on that
2026.
on April 2nd. And then, of course, it matters in terms of how it actually plays out. The Fed does not want to front run this. I think that's the most important message that Jay Powell is going to try to point out, that he's only going to react to whatever happens in the economy that keeps him out of the political fray.
Diane, we talked to a lot of people in fancy zip codes who tell us things are slowing down, whether it's Morgan Stanley or UBS today. What do you see where you are, from Aurora over to Gary, up to Waukegan? I mean, within the Goolsby district, what are you actually seeing in labor dynamics?
We are seeing some slowdown. I spend a lot of time talking to a lot of small businesses in the area as well. And one of the things we're really starting to see is things like that pullback in restaurant spending that we saw in retail sales, this sort of hesitancy, builders complaining that people aren't walking through, doing the, seeing the kind of looking for houses that they had seen out there before, not seeing the foot traffic they once did. Those are things that are important because that's sort of reflective of some of the consumer confidence numbers. Now, we've also seen a lot of front running of tariffs, and every company I know out there is trying to hedge their tariff situation. That's already pushed up costs of many things even before the tariffs that we have currently went into effect, and they're now having to deal with that as well. And that's a very challenging environment. There is a real chill, of course, in terms of what is the carve out for USMCA, and many companies that technically qualify for USMCA and the carve-out that they hope to get in the auto industry on April 2nd, they did not apply for the permission on that because there just wasn't a reason to before, and now they have to be certified. So this scramble in terms of, I'll tell you, our tax and customs group, and I'm working with them constantly, and logistics are absolutely slammed right now.
Diane, there was a time when Tom and me got in trouble for calling an ECB news conference a snooze fest. we're not going to get in trouble this time around because this won't be a snooze fest. This is gripping stuff, Diane. I just wonder from your perspective what you would ask Chairman Powell as that news conference begins in 10, 11 minutes' time.
I think the most important thing to ask, because he's not going to be able to tell you what the actual reaction function is, but we know they're doing scenarios. He talks about scenarios. We need to sort of push him on what are the scenarios that the Fed's looking at.
I'm looking for higher prices, man.
What does that mean for policy?
Just going to hold firm with the daily
Ian
picture, the
Lincoln,
daily
publisher,
bias.
Bank of Montreal, BMO. He supports John
I'm going to do
Farrow's
some
view.
forecasting
The
by marking out some
distribution
potential
of
moves, though, in the
projection
meantime.
shifted hawkishly.
Look, the fact we're having
And,
a debate
we
about
can
it means that
see
Chairman
how
Powell has to
markets
address
reacting.
something
It's
in about
hawkish.
10 minutes' time. Dan Swonk says it's hawkish of KPMG. Dan, appreciate your time as always. Bob Michael of JP Morgan Asset Management says it's dovish. Now, maybe we can explain this by saying that there are different seats here. One is an economist, just talking about things as they see them. Another is a market participant saying, well, this is what was priced and this is what was expected in financial markets. And maybe you can make that argument this afternoon. But I do think if you take the market out of it, Lisa, if I just looked at those forecasts, if you told me they'd be downgrading growth expectations and maintaining interest rates, in fact implying that maybe it'll be 2 cuts or less, not 2 cuts or more, based on where the median dot and the distribution of dots was last time around, I think we'd all agree that that was a touch hawkish.
I think the vocabulary has changed. And frankly, this scenario is gotten away from the vocabulary that we used to use in a very different time. If you're talking about stagflationary-like environments, suddenly the definition of hawkish and dovish takes on a very different approach.
The rules have changed. Matt Lazzetti joins us now of Deutsche Bank. Matt, welcome to the program. We've got a split decision here. You're going to be the break-in vote. Matt, where do you go? Is this dovish or hawkish this afternoon? What is this?
I would love to be the two-handed economist at this point, just telling you it's either hawkish or dovish. I think, given the downgrade to growth and the increase in the unemployment rate, the fact that you saw an upward shift in the dots is kind of clearly a hawkish signal. At the same time, the fact that the Fed is telling you that they are cutting rates and median expectation 2 times this year, with core PC inflation that's 80 basis points above their target and growth that's essentially around potential, kind of continues to signal that there's a dovish bias there. So I think there's kind of clear elements of both of these here. I think the market's view is it's not as hawkish as was anticipated. I think there was a fear of a median of 1 rate cut for today, and so far at least that fear was alleviated.
Matt, you expected them to pause their quantitative tightening, this idea of allowing their balance sheet to shrink. Does this actually mean anything other than just a technical adjustment to smooth the gears of Wall Street?
No, I think for the Fed, this is clearly a technical decision. They slowed rather than paused. But again, I think that was kind of a technical decision about how they were going to deal with MBS and the fact that they might have to buy in the secondary market. And so really, this is just the Fed telling the market they're going to be very cautious in dealing with the balance sheet. They don't want to repeat the mistakes of September 2019. And they're going to be just cautious in dealing with how things evolve here.
I'm going to go to strategist John Farrow on this. You can't make this up. Out on Twitter, Ed, thank you so much for this for John Farrow. My 16-year-old son has saved $500 and wants to invest
still
it.
dropping, to be fair with you.
After the press
From the era, about
conference.
8 pips.
What do you think?
That is the
One-to-one
trillion-dollar
archery
question.
there.
Matt Lazzetti, how do you think the chairman will approach this news conference in 8 minutes' time?
I want to see what the Fed
Look, I
is
think he
going
should
to
just
say.
be repeating how he's
first.
been discussing the outlook, which is there's a lot of uncertainty at this point in time.
it's
They still
really
think the
unfortunate when
economy,
gold
and
heads to
labor
all-time
market are
highs.
solid.
It just
They're in
doesn't
a
really
wait-and-see
give
approach here, and they're in no hurry to adjust rates.
reason
And
for
I
us to
think by the
trade
May
it.
meeting, by the June meeting, they're going to have greater clarity
Trades
on how
come
some
few
of these
and far in
policies are working
between.
out. They're also going to have greater clarity on the fallout from the big spike in uncertainty that we've had over the past month. So by May or June, I think we should be hopefully in a reduced uncertainty environment with greater clarity about what the policy outlook is.
Matt Lazzetti of Deutsche Bank. Matt, one of the best. Appreciate it, sir. That news conference is about 7 or 8 minutes away. Whatever you think about the decision, you've got to reflect how the market has responded to it. There's always a signal, some information there. And right now, the equity market is firmer off the back of the decision, Lisa. We are firmer by 0.8% on the S&P.
Because they maybe caused quantitative tightening, maybe because they still signaled 2 rate cuts. All I know is on the margins, the bond market is sort of slowly getting around to the same kind of dovish response to this meeting. Again, hard to say what that means, especially given the fact that this news conference is going to be the most important part of this whole 3-part act.
Bob Michael, you've seen a million of these in the past. What's unique about this news conference with Chairman Powell that's just about to start?
I've been watching a couple things. For the last month, we've watched gold go up and flows into short-duration government bond funds, which told us investors were looking for the safest anchor in the storm. While we're seeing equities drift higher today. Maybe it's a little bit of relief. We're seeing the same response. Investors are trying to counterbalance that. Gold has turned up. It's about up $5 an ounce. It was down, and money's gone into the Treasury
pushing
market.
back down now.
This defines the conundrum in markets. It feels good right now.
I want to see what we're going to do. Like, if we don't come down into the candle,
when broader tariffs
at least let's see what it'll do inside here,
John,
inside of the imbalance.
Gold is up to record highs.
All-time highs.
At least inside of the imbalance.
Which
Let's see
raises
what
a
it does
question
there.
about what's going on. Is there this larger question about assets moving away from the United States? I just wonder, you say it feels good now. Does this feel good? Does this sort of projection feel good for anybody? I mean, what do you do with this? How come risk assets seems to still be looking for a Fed put at a time where the Fed is telling us we have no clue what to do?
I think everyone's relieved that the Fed didn't jump to significant conclusions, that you're not seeing 0 or 1 rate cut. And I know there's a change in the balance, that they didn't raise inflation expectations to over 3%. I think we'll look further into the statement. I think investors took comfort from that this is going to be a balanced and stable Fed. They know about as much as we do, and who knows what's going to happen over the next couple months.
Is Fed policy still in a good place?
It's in a great place. It really is. I think it's a miracle. They got us to 4% unemployment, 4% wage growth, 2-ish% GDP, 2.5% inflation from where they were, and now they've been dealt a real problem with a global trade war, which is a stagflationary economy killer.
So I'm going to ask the question slightly differently then, but it's the same one. Is the Federal Reserve in a good place? For any central banker facing downside risk to growth and upside risk to inflation, it's not a good place, is it?
No, I told you, mark your calendar for 2031. That's when the tape of this meeting will be released. It's fascinating. The tension in the room must have been through the roof.
Lisa, regime change. Totally different place for this Federal Reserve to be in compared to where they were before. And I remember earlier this week you talked about the contrast between now and the pandemic. And you made the point that in the pandemic, it was easier for the Federal Reserve because they knew what to do. Just respond with lower rates and buy everything. This time around, it's difficult to know how to respond to these kind of shocks.
And frankly, there still is a lot of disagreement about whether some of these tariffs are disinflationary ultimately down the pike. Right now, they have to not overreact at a time where they are very worried about unemployment rates going up because they
Fed's
know
going to be speaking
how scarring that
in
can be for an economy.
4 minutes.
Sort of long lag.
Jerome Powell's going to come do the dang
point
bang.
out that whatever anybody's politics, at any time you pick up your cell phone and you look at names 6, 7, 8 newspapers, including Bloomberg News, people are shocked, John, at the cacophony of headlines. I think the Fed is part of that discussion. They have to be incredibly ex post until they see those headlines work out, political headlines.
It's one of those meetings, Tom, where you can sort of create a narrative out of everything here, hawkish or dovish. I do think it's material and something we haven't talked about just yet. If you look at the forecast for core PCE, yes, they had to revise that higher for this year, but I think it's notable. You really start to gauge how the Federal Reserve feels about if there is an inflation shock, how long lasting it will be. Now, I don't expect them to use the T word later on in this news conference, but it's implied in the forecast. They're looking for 2.8% in 2025, relative to the previous projection of 2.5. But then you look at 26 and 27, unchanged at 2.2% and 2.0%. We're trying to tease out what they really think about policy without them telling us what they really think about policy. And I think that's one way of doing it.
So let's translate this. What this means is that there's initial adjustment up in prices with the tariffs, with some of the other trade tensions, with slower growth coming down the pike that limits demand because the supply is not going to be somewhat constrained or more expensive. And then you get disinflation because they have to ultimately lower their prices. This is what they're trying to gauge out. What their role in this is a lot less
All right,
clear.
market's a little bit slow right now.
Transitory in those forecasts, Bob.
John, you know what's amazing? We're 2 months into an administration that's creating this volatility. The Fed and we have 3 years and 10 more months of this to go. Think about that.
They've still got to
3
wait for
years
April
and 10 more
2nd.
months.
The big changes come at the start of April.
So this is really something they have to deal with. How do they signal steady, calm, predictable hand at a time when everybody's heads are spinning and they cannot react too quickly? That is going to be a difficult thing to message, given the fact that a lot of people are saying this has to do with policy changes that haven't been firmed up, that are still negotiations more than just pure policy.
We're beyond the world where you can provide forward guidance. So we're not expecting sort of clear clarity on any forward guidance, but this is the kind of world where you need to clearly establish the reaction function. How will you as a committee respond to certain scenarios? That's what we want to hear in this news conference, I think, and that's what we want to see from the chairman when that news conference begins in about 60 seconds' time.
And what you're going to get is some people thought this. Some people
At least
thought
the
this.
stock
Chris
market
Waller
has recovered a
dissented
little bit
because
as
he
well.
might be or might not be in the running to be Fed chair. This is going to be
Just
a very
a little
difficult messaging
recovery.
act for Fed Chair Jay Powell, especially given the flipping and the flopping from December.
Like, we're in
to
prime
January.
areas
Governor
to
Waller can
push up.
speak for himself. I'm sure
Look
he's
at
got
this
other
imbalance
ambitions
inside
that
of
maybe
here.
Chairman Powell doesn't want to talk about in
We're
this
in
news
prime areas
conference.
to
Bob,
push
you're
up
always
for sure.
fantastic about this. What would you ask the chairman in this news conference if you had a seat in that room right now? What would be top of mind?
I'd ask him what the Fed is watching to gauge inflation expectations.
What do you think they are watching? Because it doesn't seem to be the survey data. Or is it the survey data? Have they been spooked by that? Is it the hard data? Is it both?
I think it's a combination of both, and I think it's also going to do from their survey of small and mid-sized businesses, see what they're going to do with the price increases and see how much of those they'll push through.
How much weight they put on all of this will be incredibly important. The chairman of the Federal Reserve with a very challenging news conference. That news conference begins right now.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years.
Big man speaking right now, guys.
Labor market conditions are solid, and inflation has moved closer to our 2% longer run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We also made the technical decision to slow the pace of decline in the size of our balance sheet. I'll have more to say about these decisions after briefly reviewing economic developments. Economic activity continued to expand at a solid pace in the fourth quarter of last year, with GDP rising at 2.3%. Recent indications, however, point to a moderation in consumer spending.
You guys can't hear the
following
audio,
rapid
right?
growth seen over the second half of 2024. Surveys of households and businesses point to heightened uncertainty about the economic outlook. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.7% this year, somewhat lower than projected in December, and to rise a bit below 2% over the next 2 years. In the labor market, conditions remain solid. Payroll job gains averaged 200,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and is held in a narrow range for the past year. The jobs to workers gap has held steady for several months. Wages are growing faster than inflation and at a more sustainable pace than earlier in the pandemic recovery. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year and 4.3% over the next 2 years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 2.8%. Some near-term measures of inflation expectations have recently moved up. We see this in both market and survey-based measures, and survey respondents, both consumers and businesses, are mentioning tariffs as a driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.7% this year and 2.2% next year, a little higher than projected in December. In 2027, the median projection is at our 2% objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. Looking ahead, the new administration is in the process of implementing significant policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. It is the net effect of these policy changes that will matter for the economy and for the path of monetary policy. While there have been recent developments in some of these areas, especially trade policy, uncertainty around the changes and their effects on the economic outlook is high. As we parse the incoming information, we're focused on separating the signal from the noise as the outlook evolves. As we say in our statement, in considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We do not need to be in a hurry to adjust our policy stance, and we are well positioned to wait for greater clarity. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. An admittedly challenging exercise at this time in light of considerable uncertainty. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year and 3.4% at the end of next year, unchanged from December. While these individual forecasts are always subject to uncertainty, as I noted, uncertainty today is unusually elevated. And of course, these projections are not a committee plan or a decision. Policy is not on a preset course. As the economy evolves, we will adjust our policy stance in a manner that best.
Okay, so DXY has finally reached that 15-minute candle. To be honest with you guys, this does look like it will continue dropping. I can see here on EU as well, we are heading higher, right? So, ideally, what we can anticipate for tomorrow, if we can see these highs get taken, right? If we can see a push above these highs tomorrow, we can look for a pullback for an entry, right? Somewhere around there, put our stops beneath the low, and then target a new higher high. Okay? Because I'm watching this PA that we're currently getting. The likelihood that we're going to get a nice move that continues tonight is highly unlikely. Gold, in other news, is just absolutely going for it. Another new all-time high coming soon. Like, there's so much more upside potential for gold. Like, gold can definitely keep going. It can keep going and keep going and keep going. Fed is not being very hawkish or very dovish in what he's saying, but it's not enough for you to believe that price is very bullish, at least for the time being anyways. He's pretty much saying, yeah, guys, that we're doing our best to manage things, and the economic data is not as bad as what we foresaw it as. Okay, and he's given some data with the outlook, for let's say 3-6 months time ahead, and it's all looking pretty good, right? So for the time being, let's just play the structure that we see on the daily, and we'll see how this progresses throughout the rest of tonight. I think tomorrow does give us a bit of an opportunity to go long. Hopefully Euro USD decides to play ball tomorrow morning, and we'll see how it goes, because we are midweek. This week I haven't caught anything really significant. This trade here is the only trade that's been significant on gold, and we missed that trade there. Tuesday we also had a little pullback here come London session for a nice little buy. As of lately, you guys would have noticed that I have been looking at London session a lot more, just because gold is at all-time highs. So I am forced, unfortunately, I am forced to look at London session for potential moves, because New York is barely going to give us a move, especially as you guys know that I do trade gold. So right now, if gold's not playing ball, I'm going to look at other pairs and I'm just going to adapt. I'm not gonna let the market stop me. I'm just gonna adapt. It's that simple. All right. So for now, I would say for you guys to watch this 15-minute candle here on the DXY, see if it can be a catalyst for us to get a new high, or if price wants to push through. Okay. Depending on what this setup does tomorrow, it will lay the foundations and the groundwork for tomorrow. Okay. I don't think we really need to rush into anything, at least for now. I don't think there's anything available for now. Let's just let price print. Because I'm looking at the likes of EU, GU. GU is very bullish as well. ADUSD, very bullish as well. You know, realistically, there's no reason as to why we should continue pushing down lower, right? Structure is telling us that we should see all-time, well, not all-time highs, but another high on the daily. And that's what I'm really working with here. And that's the thing though, you know, it's not always going to be the easiest to find the low of the day or the high of the day, right? Or the low of the week. Because realistically, this does look like the low of the week, if I'm not mistaken, is it? Let me see, where's Monday? Yeah. So literally, we've just punched beneath last week's. Sorry, we've just punched beneath the low of the week, right? This wick we've had here off of the interest rate is actually the low of the week right here. So could we potentially get the low of the week here and then finish off giving us a new high of the week? These are all many questions that you're going to ask yourselves whenever you are looking at the market. So right now, yeah, ladies and gents, we're just going to take it easy. You know, price is not in a hurry to go anywhere, especially as the Fed is speaking and answering questions right now as well.
Term inflation expectations, and people who fill out surveys and answer, questionnaires are pointing to tariffs about that. If you look in the survey world, if you look a little further out, you really don't see much in the way of an increase. Longer-term inflation expectations are mostly well anchored. If you look at the New York, for example. Then you have market-based, and it's the same pattern. You know, people in markets are pricing in break-evens. Some higher inflation over the next year must be related to tariffs. We know from the surveys. But if you look out 5 years or the 5-year forward, you'll see that break-evens are either flat or actually slightly down in the case of the.
Okay, Mr. Jerome, whatever you say, my man. Whatever you say. But so far, I think the foundation is being put down right now for tomorrow. Right, we've just busted low down the 15-minute. I like this, guys. I like this. So what we want to see is hopefully, okay, hopefully we don't actually see this create a new lower low, because this volume is really heavy right now. Right, if we can see price start to stagnate and maybe we get a slight bit of pullback during Tokyo session inside of here, right? So even if we come low and then we kind of just consolidate, Asia session opens, we push up a little bit, then we want to see pre-London session, we go for the high of Tokyo, and then we look for a sell somewhere inside of there, and then we can target the opposing low of Tokyo session, and then go for today's Tokyo session low, and then final TP can be a new daily lower low. Okay, like volume does look really strong right now, incredibly strong in fact. Incredibly strong. Okay, goes at all-time highs again. Let's leave this for now, guys, yeah? We'll have to come back to this. Okay. Thank you guys for joining me on live stream today. Tomorrow looks exciting. Money day, guys. I'll see you soon.